All right, let's get right into it. On the surface, this looks like a simple story about one crypto stock having a really, really bad day. But when you start to pull on that one little thread, it unravels this massive, hidden connection that ties Wall Street chaos directly to a decision made 6,000 miles away in Tokyo. And it is a wild story of cause and effect. And this is the number that kicked everything off. On December 15th, the stock for Bitmine Immersion Technologies, that's ticker BMNR, absolutely cratered. We're talking an 11% free fall in just a single day. I mean, that's a brutal move that sent some serious shockwaves through the market. But here's where it gets weird. The whole point of BMNR is to track the price of Ethereum. But on that same day, Ethereum only dipped about 3%. So you've got to ask yourself, why on earth did this stock fall more than 3 times harder than the actual asset it's supposed to follow? What is going on under the hood here? Well, the answer is that BMNR isn't just a simple tracker. It's built to be a magnifying glass for Ethereum's price. Think of it less like a mirror and more like a massive lever. A tiny push on one end creates this huge swing on the other. And to understand that 11% crash, you have to understand why this company is what's called a highly leveraged pure-play vehicle. The sheer scale of this company's bet is just staggering. It holds nearly 4 million ETH. To put that in perspective, that's over 3% of the entire supply of Ethereum in existence. So its valuation is almost 100% tied to the price of this one very volatile asset. There's no diversification, no safety net to cushion any blows. It is a massive all-in bet. And this is where you really see the effect, because its entire value is tied up in that ETH. Any small move in Ethereum gets amplified, like exponentially in BMNR's stock price. When ETH pops up 3%, the stock can rocket up 11%. But, as we just saw, when ETH dips just 3%, the stock crashes 11%. It's a classic double-edged sword that was incredibly painful if you were holding it that day. Okay, so now we know how the stock crashed so hard. But why did Ethereum dip in the first place? Well, to figure that out, we have to jump all the way across the globe to the Bank of Japan and this legendary financial trick that's finally, after decades, starting to come apart. So this whole thing is called the yen carry trade. And for decades, it's been like a force of nature in global markets. The setup is actually pretty simple. Huge funds borrow Japanese yen at basically 0% interest. They swap it for US dollars, and then they just pump that super cheap money into riskier things with higher returns, like stocks and, crucially for our story, crypto. And you can really think of it like this. For years, Japan has basically been a massive free ATM for the entire world, just funding global speculation. This fire hose of cheap yen has been the invisible backbone for so much of the risk-on appetite we've seen. But what happens when that ATM suddenly starts charging fees? And this is the trigger. The markets started freaking out because they're expecting the Bank of Japan to finally raise interest rates on that giant global loan. The fear is that rates could jump to 0.75%, which would be the highest they've been since 1995. Now, that might not sound like a lot, but for a huge fund using tons of leverage, that is a massive hike in your borrowing costs, and it forces them to start selling assets fast to pay back those now expensive loans. And listen, this isn't just some theory. We've seen this exact movie play out before. Every time the Bank of Japan has even hinted at a policy change, like back in July of 2024 and then again in January of 2025, it has caused a sharp, immediate drop in the crypto markets. The sell-off we just saw is a predictable pattern, a direct result of this funding machine grinding to a halt. So, that's the story of the crash, right? A short-term panic driven by the weird plumbing of global finance. But here's the crazy part. For some really important people in the market, this painful event isn't the end of the world. In fact, they see it as a necessary step before a massive long-term boom. And that view comes from Tom Lee of Fundstrat, who, and this is super important, is also the chairman of BMNR, the company whose stock just crashed. He basically saw this coming. He says this isn't a crisis, it's a cleansing mechanism. It's wiping out all the over-leveraged players to clear the deck for what he thinks is coming next. And what he believes comes next is, well, it's kind of mind-blowing. Lee is on record forecasting that Ethereum could hit anywhere from $9,000 to $20,000 by the end of 2026. So what could possibly justify that kind of insane price target, especially right after the crash we just walked through? Well, the answer, according to this super bullish view, is not going to be another retail-driven hype cycle. No, the driver this time is supposed to be something totally different: the tokenization of real-world assets, or RWA. Basically, we're talking about the movement to take traditional stuff, T-bills, real estate, private equity, and put their ownership onto a blockchain. We're talking about a potential multi-trillion-dollar shift in how finance works. So, where are all these trillions of dollars in tokenized assets going to live? Well, Lee's entire thesis rests on the idea that Ethereum is going to be the unavoidable piece of infrastructure for this new financial world. I mean, it's the dominant network, it has the biggest developer community by far, and it's got a proven track record of 100% uptime. The bet is that it's going to become the critical plumbing for the future of finance. And while it's easy to get fixated on Japan tapping the brakes, you have to zoom out and see the bigger picture. And what you see is this fascinating global tug-of-war. While the Bank of Japan is tightening up, the U.S. Federal Reserve is already signaling rate cuts into 2026, and countries like China are pushing out huge stimulus packages. So even as one country causes a little panic, the world's other major economies seem to be flooring the gas pedal on liquidity. So what does all this add up to? On one hand, you've got a short-term panic caused by a change in how money moves around the world. But on the other, you have this belief in a massive, long-term boom driven by real, institutional adoption. It really does feel like we're at a fundamental reset point. And that leaves us with this one final massive question. What does the end of this giant free money trade really mean for the future? Does getting rid of all this cheap funding finally force crypto to grow up, making it permanently dependent on regulated institutional money instead of these weird global trades? It's a huge structural shift, and you can bet we'll be watching how it plays out for a long time to come.